Good afternoon. This is Leanne Hicks, Seminar and Event Coordinator with the Michigan Manufacturers Association. Welcome to our webinar presented by Mike Semanco, President and Chief Operating Officer for Hennessey Capital, a division of Hitachi Capital America Corporation. Hennessey Capital provides working capital solutions and business coaching to small and mid-sized businesses. Mr. Semanco has over 20 years of experience in the financial service industry. A native Detroiter, he has a bachelor and master degree in finance from Walsh College. He's active within the business community, has several industry articles, has published, and participates in many panel discussions on small business financing and strategies. And now let's begin our webinar presentation, Strategies to Increase Profitability.
Great, thank you, Leanne, and thanks to everyone joining us today on the webinar that we're presenting. Today's webinar is going to be talking about how cash flow is so important to a growing business. Everybody hears the terminology that cash is king, and today we're going to be talking specifically about why that's so important to a business in growth mode and why that they need to focus really on the planning stages to take care of every opportunity that gets presented to them. When we look at small and mid-sized companies that we work with, we analyze really 5 reasons why a company underperforms. And there's a whole host of other solutions and kind of challenges that go along with running a business. But here are the 5 that we're going to talk about today and the ones that we feel that are most important. Poor cash flow management. Obviously, we're talking about cash is king and how can we manage cash flow on a day-to-day basis. And we see that as a huge barrier to growth for companies. Lack of performance monitoring. This includes managing the data that is driven by forecast and projections. The improper use of debt. How does a company use working capital debt to fund the day-to-day expenses and use long-term debt for really the assets that are going to be producing product over a period of time? Being reactive versus proactive. Again, focusing on the moment is not the best planning technique, so we'll go through a little bit about how companies can work through this. And the lack of focus in communication. Communication is key no matter what business you're in, and you need to do that not only to your employees but also to your vendors. So these are the 5 items that we see are really that can be holding companies back through their growth period, and we want to address these over the next half hour or so. When we look at cash flow and how do we improve that through our business, we really look at 2 areas. One is enhancing profitability, so how do we increase that top line, and also how do we manage the expenses that are associated with our business, and that's managing the below the line, making sure that we're maximizing and being very efficient. We're also going to look at working capital management. Understanding when we have cash coming in and we're going to be spending cash on inventory or also on suppliers, how do we manage that and how do we match those 2 to make it very efficient for us on a go-forward basis? You're going to hear all through the presentation today that planning is going to be critical to address all the success that you could possibly have with opportunities. The more advanced planning you have from a cash flow perspective, the more you'll be prepared when crisis, if they arise, do arise. So let's start with looking at profitable sales. We've looked at many companies over the years, and all we hear is if I had more sales, I'd be able to pay my bills. Well, we understand, as most businesses do, that a sale does not pay bills. The actual cash pays bills. So it's very important that a company is going to be focusing on having a good sale. And that's one where you're going to be addressing your purchase price, your sale price to the customer, your purchase of goods and vendor suppliers, and also making sure that you can collect that sale at the end of the day because, again, cash is king and cash does pay bills. So we try to encourage companies to create a sales culture where not only from the sales perspective but also through the accounts receivable and management side, but they're really focused on what sales make a good sale, making sure that you have profit in each of those sales and making sure that through the collection process, you're getting that profit back after you purchase product from your suppliers. And also looking at sales, we've seen diversification over the years really costing a company a lot of money. It can be very expensive. It can be very distracting. So making sure that when you're looking at expanding your sales geography or possibly your product mix, making sure that stays very close to your core business and not getting too far outside of your production box. On managing cost, in the next slide, we look at where is the operational cost coming in. In the manufacturing environment, obviously, capital expenditures is a big portion of a manufacturing client. And looking at, in today's market, an abundance of equipment that's available in the used market versus the new market, we're having a lot of clients look at that as a strategy. So looking at used equipment versus buying it new, and also looking at buying equipment not in advance of getting the orders. They're buying the equipment once they have the order in place and ramping up to those sales orders versus taking the strategy of buying the equipment and hoping to get the order at some point in time in the future. And they're also looking at ways in which they can lease a piece of equipment versus buying it. That will help with the down payment and kind of soften the cash outlay over time. Along with the equipment side of the equation for costs, companies are looking very strategically at how do they maximize their staff and also their plant efficiencies. When a company is growing, typically they will see gaps in their workforce. They may have areas that are at complete capacity in growth mode, and there may be other areas of the business where they have some idle time. That's a perfect opportunity to do some cross-training between those staff members and really gain some plant efficiencies. In looking at the environment of sales, as we talked about earlier, the operational cost side of it is how do I produce product at a higher margin than at a commodity margin? So we have clients that we've talked to and we've presented to that really have gone through the process of what can I do within my shop that I can add value to, which allows me to deliver a higher price to my customer so that I can gain more margin. And on the commodity business, where it's a process that they can outsource to somebody who can do it cheaper than they can, that will help them maximize their cost structure. So they're adding value and looking at what is the value I can add to a piece of product, and can I outsource the commodity side that somebody can do it much cheaper than I can, and again, try to maximize both ends of the equation. We also look at teaching companies that each piece of the business should be operated as a profit center. So as your purchasing department is looking at buying materials or a product or even in-house items, how can they view it as, if I'm maximizing my buying power and I can get the lowest price for my materials, that's obviously going to flow through the production cost directly to the bottom line. So if they are allowed to operate as an independent profit center and have some accountability on expense tracking, that goes a long way in dropping margin to the bottom line. In addition to the product cost, the operational cost, companies also look at, in order to maximize cash flow, is the overhead expenses. Not only on the personnel side and maximizing the efficiency of your staff, but also looking at SG&A expenses, all the way from insurance, whether it's workers' comp or general liability insurance, to office supplies, marketing expenses, everything that really impacts the bottom line of the business. And the more that you can get your employees involved in this cost reduction process, the more energized they will be. We've had we've seen companies reward employees for cost savings in a particular area, whether it be something as small as ordering lunch for the staff, if they're able to save a certain percentage off of what they order for expenses or material, or all the way to gift cards for employees to reward them for their success. And again, it's employee engagement, and having them part of the solution really allows them to get engaged. The other thing that's important is companies that are trying to cut expenses during the middle of a crisis usually never works. So that advanced planning we talked about earlier if there's any type of downtime in your business, whether it's a week of shutdown or a week of production, that's a good time to really sit back, look at your process, look at the expenses, and really have an understanding of those inflows and outflows, and how do you really create some efficiencies during that time. It's very difficult and usually short-sighted when companies, when they're in crisis mode, to look at reducing costs, because usually at that point in time, the costs that get reduced are very detrimental to the business, and it really turns out to be more expensive in the long run. The last piece of the, in looking at kind of the cost side of the equation and really the kind of the increasing the cash flow piece, is looking at leveraging partnerships. We've had, again, seen many companies, we instruct companies to, how can we leverage another partner of yours in the business, or maybe a complementary business, to possibly leverage their idle equipment, or possibly storage facilities to help you out as you're going through growth mode. And creating these strategic partnerships and leveraging a cost savings between both entities is a win-win for both parties. We also have seen entities look at joint marketing opportunities. So again, those complementary businesses can team up, and if they're going to be doing a trade show, can they partner during that time frame in order to share the cost of that trade show and marketing in order to be out in front of that joint client. Sales compensation reviews. At the year end, as we're looking at expenses and we're looking at how the performance of the company has been, can we go through our sales compensation process and make sure that we're market, make sure that we're rewarding our sales staff and our overall staff for the right reasons, and making sure that we're competitive in that space. We're hearing more and more about how companies are using other things besides just pure salary compensation as a way to reward employees. And it certainly goes a long way. If you can stay into kind of the latest opportunities and what's market for your employees, it keeps them engaged and it keeps them connected to the company on a long-term basis. We've heard the term, being able to barter your services and look at revenue sharing. There are many ways in which you can get creative in looking at, how can I work with another company that, one, I may be a competitor to, or look at a company that is a very complementary piece of business to what I'm doing, and figure out ways in which you can share time. We've seen instances where complementary businesses will share general managers and plant managers so that they can capitalize on the expertise of somebody who's acting as more of a third-party consultant and really leverage that time and that expertise to help them improve their process. So as we talked early on about kind of the early stage of the growth of the business, we talked about kind of the strategy of maximizing profitable sales, understanding your expenses, and now we're going to talk a little bit about the working capital management. So really taking a deeper dive into the ins and outs of cash flow, forecasting, projections. And we all know that when a company is growing, growth can be very expensive. That's when cash is at a premium. It's very expensive to take on a new customer, so that advanced planning process needs to certainly be in place. So in this slide, when we're looking at the ins and outs of cash flow, business growth typically creates cash concerns. As I said, cash growth is very expensive, and a substantial amount of cash goes into developing a new product or possibly a new customer, and you've got to be ready for it. Typically, most businesses fail due to the lack of cash versus the lack of sales. We've seen it multiple times where a company does get a new order in or lands a new customer, but they don't have the cash flow to support the inventory that they need to buy or the labor that needs to go into producing that product for the customer, and they get behind the 8 ball. So the key is really understanding that cash cycle, and when you're looking at a process or a new project, understanding what is the flow of cash throughout a company from the time that you get a purchase order to the time that you can collect that invoice at the end of the day. So we'll talk a little bit deeper about that real receivable flow and how that can be managed. We talk about not only on the receivable side and speeding up, through negotiated terms and accelerating receivable payments. How do you manage the outflows to your suppliers and making sure that if if you have a customer who is taking 90 days to get paid, is there a way you can match up the suppliers on that particular product closer to that 90-day payment window? Or do you have enough cash flow planning in place to actually pay them early and get a discount to offset the cost of that financing through your bank or through others? And the key, as we talked about earlier, is really the communication. Making sure that open communication with your customers and your vendors to let them know where you stand within the cash cycle. So we'll talk a little bit further on about becoming a bank for your clients. How do we prevent that from happening? And how do we let our customers know that that 45-day net payment term that they promised really can't go out to 60 days or 90 days because you put your company in a bind in order to address payments on a timely fashion to your vendors. So let's look at cash flow projections. We've seen numerous business plans, and I'm sure folks on the webinar have seen the same, where you've seen situations where you have a year or two of cash flow projections, and knowing that businesses change on a day-to-day, week-to-week basis, it's very difficult to project what your cash position is going to be in 2 years. So we try to focus clients on looking at a 13-week rolling cash projection. That's really a short period of time in which it can be modified. It's a rolling process, so if there's changes to the collection or the terms, it can be done on a very dynamic basis, so the planning process is much tighter to reality. Making sure that you understand the cash collection side and the sales side. Again, if that customer is anticipated to be paying in net 30, what is reality? If they really pay in 45 days, that's what really should be put into your cash forecast, not the payment terms that are on your purchase order. Cash disbursements, again, understanding what the critical time frames are for paying your suppliers, if there's ability to take discounts that can lower the ultimate cost of the product, making sure the payroll costs are covered along with taxes, and then critical vendor payments on the SG&A side. What can be advantage from a term perspective? Can you work with a company to have 45-day terms versus 10-day terms if you're working with somebody that is more in need of cash on the front end? If you have to pay them in 10 days, can you obtain that discount? And really understanding what the debt service and extraordinary cost of a company is. So startup capital. So if I have a new process or a new project that I'm kicking off, what are those extra costs that have to be included in my cash projection so that as I go through this process, I don't forget about those, because those are critical pieces that really, if you find out too late in the process or in the project, could really prohibit you from finishing the project with that client. And also understanding from a banking relationship what assets are eligible that you can leverage in order to obtain a bank line of credit. So receivables, inventory, equipment, what's eligible versus what is not. So if you're getting into a large tooling program and you think, off the top of your head as you're going talking to your client, I should be able to finance these receivables through my lender. Make sure you have that conversation with them on the front end to make sure that those tooling invoices are eligible under your borrowing certificate. Because the last thing you want to have happen is to walk into your lender and they tell you that it's an ineligible asset and they can't lend against it, and then you're going to have to fund that on your own. So again, that pre-planning process, cash forecast, and the projections are very critical to a company. We talked a little bit about the managing accounts receivable, and now we'll get into really the key components of cash forecast, starting with receivables. The process, again, having a process in place, understanding who your customers are, understanding what their typical terms are, allows you to put together a strategy before you walk into signing that purchase order to really be able to negotiate terms that are in your best interest as well as your client's best interest, your customer. So is there a way in which you can establish a credit policy and understand how much in sales or credit limit you should have out with that new customer of yours? Understanding what their billing process is. So can you bill every 30 days, or can you bill when product is shipped? Do they receipt the invoice into their system at the end of the month versus when you give it to them? So all of that plays into the receivable management side so that you understand exactly when those customers are going to be paying you. And again, that's critical to the cash forecast. Leveraging your sales staff to collect past due receivables. It's a huge component. It can be a very easy customer service call when your sales staff is out there making sure everything is going well, having them add another question as to those invoices that are outstanding, is there any issues with them, or did you lose the copies of them, can I help you out? Getting them actively engaged in collecting those receivables that are stretching is very key, and you can really position as a customer service call. We talked earlier about leveraging your bank to provide working capital secured by receivables, and that is key, making sure that you have a working capital facility that can fund the growth of a business. It's very difficult in a situation where if you don't have day-to-day working capital, if you have to wait 45 or 60 days for your customers to pay you, and you have payables that are due within 15 or 30 days, that mismatching of cash flow becomes very critical and usually can be very stressful. So if there's a way in which you can set up a receivable-based line of credit to really accelerate those receivables that will be paid in some point in time in the future, if you could utilize that cash today and take advantage of supplier discounts in making sure that your vendors and suppliers are satisfied on a more liquid basis, obviously the more credit they're going to be able to extend to you. And lastly, we mentioned this earlier about not becoming a bank for your customers. Your customers understand, because they're borrowing from banks as well, that the longer you're financing their receivables, the longer they're taking to pay you, the more it's costing you. So we encourage clients, don't forget about including that cost of financing into that sale. So if a customer says, I'm going to pay you in 45 days, but you finance that receivable and it's actually outstanding for 90 days under your bank line, keep in mind that extra 45 days that you didn't build into the sales equation is really coming out of your bottom line. So making sure that you understand all the cost components that are involved with managing a receivable. On the inventory side, we've seen quite a few times where companies have a huge inflow of inventory. They're stocking up for kind of the best case scenario of landing that large contract. And what most companies don't realize is inventory is really a liability, even though it shows up on the asset side of the balance sheet. It's a liability because you have your cash tied up into it. So making sure that you have really a perpetual system that can manage that inventory flows and manage to a just-in-time process for inventory versus a just-in-case process is very critical to cash flow, because you could use that idle cash that you don't have invested in inventory somewhere else in the business. Also having companies look at their current inventory build. So is there inventory that you have on hand that you've had there that's slow moving, or inventory that you've used for projects in the past but you don't expect to use that in the future? Is there a way that you can move that inventory either to another supplier, or can you use it in a course of business that possibly scrapping out that inventory if it's metal and get something into the company today from a cash flow standpoint is better than letting it sit on your shelf and possibly use it 2 or 3 years from now. We've also seen situations where, depending on what the inventory is, vendors are willing to take it back. If you can sell it back to that vendor and they can repurpose it for another client, obviously that'll save you cash in the long run, and obviously use that cash for other pieces of the business. And ideally, companies should be leveraging inventory as an asset, particularly in growth situations. The more growth that a company has, the more inventory they're going to have to purchase, and making sure that the buying process that you have for inventory purchases really match to the purchase orders that you have outstanding or anticipate having in the future, so that you're not buying inventory just to have it sit on the shelf. So in wrapping up for today, I wanted to cover the top 5 take-home tips that we share with businesses that we talk to, and it's kind of a recap of what we talked about earlier. And it includes understanding your cash cycle, and again, that revolves from the time that you have a purchase order in hand, all the way to the time that you collect on that receivable in cash. So understanding what it's going to take from buying inventory to producing the product to shipping it and then ultimately collecting it. Developing a plan to collect and monitor performance data. It's very critical to make decisions on a real-time, data-driven basis versus on a pure gut check. And that cash flow forecast is really key. Having that in front of you, updated on a regular basis, understanding exactly where your cash flow stands, it allows companies to manage that growth opportunity much better than if they're just looking at their checkbook at the end of the week. We try to have that rolling forecast much more on a readily basis versus doing it after the fact or when that job comes in. Number 3 would be looking at profitable sales and cost management. Again, understanding that not every sale is a good sale. Sales that are good ultimately pay, and they pay at the margin that you're expecting. On the cost management side, making sure that you're creating efficiencies, whether it's leveraging earlier payment terms with your suppliers and taking advantage of early pay discounts, or looking at possibly buying power, leveraging a customer or leveraging another complementary service to manage a bigger buying power in order to get that product at a lower cost. And again, looking at SG&A expenses, we encourage clients to look at those every quarter, making sure that they're looking at insurance, they're looking at their buying really habits, making sure that they're just not buying for the future but buying for today. Number 4 would be leveraging assets for growth capital, receivables, inventory, equipment, major pieces of a manufacturing company and major assets that can be leveraged for growth. We've looked at numerous times where a company is not using those assets in a very efficient manner, using working capital assets to fund long-term debt or using long-term assets, equipment, and real estate to fund working capital is really a mismatch. So we advise clients to get with their counsel. Typically their CPA can walk them through kind of the cash planning process and really leverage that thought process of, if I added a new piece of machinery today, could I finance that over a period of time versus paying cash up front? And if I'm looking at a company who's taking 60 days to pay, can I put together a working capital line in order to help me leverage cash sooner so I can pay my suppliers on a more readily basis and maybe take advantage of some discounts? And lastly, and really a very important piece, is being very focused on what you do best and leverage that skill set. And then communication. Communicate with not only your employees but also your vendors. If you're having challenges within your business and the customer is taking longer to pay, the first thing I would advise is contacting your vendors that are maybe tied to that project and explaining exactly what's happening. Having that open and honest communication and really just painting a picture of what's expected is much better than going radio silent on your vendors and also your employees. Again, it's all about engagement, because there are a numerous amount of companies that if they're in that position, they probably understand it because they've gone through it as well. So those are the kind of the recap of the take-home tips that I'd like to leave with you today.
Thanks very much, Mike. We appreciate your time in presenting. We encourage MMA members to contact you with any questions, and we look forward to working with you in the future.